I want to kind of introduce the Volcker demo as we're pulling it up here, but the purpose really of this demonstration is to talk about how, trade surveillance and monitoring can be thought of as in a context of Volcker. So what we've done here is this is equities trading data across about a 2-year period with roughly 10 trading desks. And how we're going to show is really our view of how the 17 metrics of Volcker really can help to explain and manage risk for an organization if you think about them holistically and not necessarily as a one-off. So, there's been a lot of discussion around, is this specific metric valuable? Is this specific metric possible to be generated? As an example, spread P&L. In the fixed income space, there's a lot of discussion around whether that's even possible to generate. The point here, though, is I think if firms approach this as an information gathering exercise that makes them smarter about their own risks within their organization and the way that they should be thinking about not just Volcker but also just managing their business. How are they making money? How are they taking on risk? Can they start to understand, is there marginal, what's the marginal risk or marginal VAR that's being taken on, to have the incremental dollar of P&L? And can we really start to associate that all together to really maybe think about risk management a little bit more holistically? And number two, to think about, when and if we do have a perspective on complying with Volcker, how is it actually going to be, how are we actually going to think about monitoring it? So with that, I'm gonna start to kind of dive into our demonstration here, and we're going to try to move pretty slowly so that, for the most part, any delays that we're seeing in the WebEx are not too effective. But again, on this first screen, we're looking at an executive summary, really of just to kind of help to explain and to capture what type of data that we're looking at. So we're looking at roughly $3 billion of positions. It's roughly 10 desks, about 26 traders, about 34 books. Up on kind of A1, we're looking at total market value over time as it's changing with desk and segments. 1B, we have a breakdown there of P&L as well as count of securities by traded desk. So, and then further broken down by the different industries. This particular organization organizes their desk, by sectors. So we have a look at, consumer discretionary, energy, financials, health, information technology, etc. Over in 1C, we're looking at a view of, what is the realized, unrealized P&L, fee and expense income, as well as their comprehensive P&L. And then down on the bottom, we have some additional trading information. So, what customer counterparties are we trading with? Which non-customer counterparties are we trading with? And then what are our types of positions that are being traded? Are they long, short, or was it sell or buy to close? So, really the heart now, so that's a little bit of a background around the type of data that we're looking at. But really, I think the heart of our approach to Volcker is captured on this Volcker heat map, which, for a lot of different reasons, the legislation and the subsequent guidance that has come out has been very unclear around what specific thresholds constitute proprietary trading. And I think the regulators did that, for two reasons, probably one that they say and one that they don't say. The one that they say is they want firms to have the flexibility to really think about this in the context of their own specific businesses. And I think the one that they don't say is, I think, frankly, they're very interested as to what firms are going to come back with as they think about this. But to me, and I think our view as a firm is that all of these concepts need to be thought about as a relative risk proposition, where organizations can focus on managing their relative risk and having a proactive discussions between risk, compliance, and front office personnel to think about what, if any, trading policy changes need to occur, if there's different strategies that need to be made around hedging or markets that are being made, but it can all be very proactive. And also, frankly, it might be that nothing needs to change, but it also allows compliance and risk to focus in on where they should expect questions to come, as part of any type of regulatory review.
Yeah, and I would say a couple things to that. I would say it allows banking entities to take a horizontal view of risk, which is, I think, it's larger than Volcker, rather than take a silo-based product control view or a market risk view. I think the regulators want to see a more horizontal slice of that, and I think tools like Spotfire allow you to start thinking about that. I also think in this tactical informed view with that I'd mentioned earlier, that to be able to start to understand your data even before you start reporting on it, to understand what it looks like and the quality of that data, that's a question that we hear consistently as well, is I'm not sure my data is great, and our answer is, so get at it, but get at it in a very analytical way. And then I think lastly is what Mike is discussing too, is there is not a bright line for prop trade. I think with tools like Spotfire and being able to view it analytically in a relational way, that it allows you to tell that story as to what may be leaning more risky or less risky. A regulator is not, no one's going to tell you whether it's a prop trade or not. You're going to have, your banking entity is going to have to defend your position as to why you thought that position or that book or that trade was appropriate relative to many factors, which is the view on what Mike was discussing.
Yeah, and so as we've talked about, there's these concepts of 17 metrics that have been published, and there's a chance that, actually I would say a strong chance that not all 17 will end up being part of the final rule. But I don't think the concepts are going to go away, which are, regulators are thinking about this along really 4 parallels, right? Risk management, sources of revenue, revenue relative to risk, and then kind of customer-facing activity to determine whether or not you're doing trades on behalf of customers versus on behalf of a house book. So, again, the guidance is very general, right? So, lower risk is, less VAR means that you're probably making more of your money on fees and commissions and less money on asset appreciation. When we start getting into sources of revenue, again, looking for revenue to be coming from areas like spread P&L, fees and commissions versus realized or unrealized gains, drives a view that it's either less or more risky. So as we've thought about these 17 metrics, the way we've tried to focus is that we want firms to be able to see a relative value so that they can start to do the investigation and better understand how at a desk, at a book, at a trader, at a desk, and at a group level, some of these these metrics interact. So what you're seeing here is we have kind of one value highlighted. So we're doing it this is at a desk level. So this is the materials desk, and you're able to see how the materials metrics are having it show up relative to its peer group. So if we start to add some of the different the different desks to this discussion, we can start to see how different industry desks are looking from a Volcker perspective relative to their peer group. So in this particular example, now that we've highlighted a couple of these areas, we're seeing that information technology from a sources of revenue seems to look pretty risky, which means that they're probably making more of their money from asset appreciation, whether that's realized or unrealized, versus spread P&L or spread P&L or fees and commissions. What it's not telling us yet at this level is why that's happening. Is that happening because the information technology desk happens to be doing a significant amount of money in thinly traded equity securities, or there was a large bankruptcy where the spreads have blown out, and they're having to hold kind of larger inventory to be able to make the market. Those questions haven't been answered yet, but what we have been able to see, really at a specific glance is, where do we actually need to focus our attention, right? Is it across the organization, or is it by a specific desk, or is it by a specific trader, or a specific book? And now what we're going to really start to walk through is, we're going to start to drill down then and how we can take this concept of a Volcker heat map to really start thinking about what are the compliance and monitoring implications around how you as an organization can think about not just a specific metric, but how metrics interact. And then finally is to really think about, well, so then what happens when we don't have perfect data, when we have data quality issues, etc. So, to start, we're going to kind of drill down in, and actually one other point on that is, as we start to drill down on tab 1, the other part of this is, as hopefully you're kind of getting out of this demo is, I still at this point don't know what is appropriate from a risk perspective. And so the other nice thing around tying together, an approach that has rapid iterative development with the ability for, people to really be engaged and to understand the data allows us to start thinking about what do thresholds look like, and as if we do start to set thresholds, how would that change our risk profile in terms of, what we would be potentially monitoring. So, to give an overview of risk management and what we're talking about here, this is showing in section 1A, really kind of the equities group, all of the different desks, what their market value is, what their total long positions are, short positions, what value they have at risk as a percentage of market value, and then what their stressed value at risk is for the 12 months with the highest volatility. And then down at the bottom, we're able to start to look at relative VAR and stressed VAR across these different organizations, across these different desks. But again, we're still kind of just seeing information from a relativity perspective, but we haven't yet thought about what is this going to mean in terms of setting thresholds. But now if we jump to 1B, which is a different cut on the same piece of data, we're able to start thinking about, relative to different desks. So at this particular case, we're really kind of looking at this at the equities, at the equities group level, and starting to look at what do thresholds do, for different desks. If we start to define, what is an acceptable amount of high-risk VAR as a percentage of market value? What is an acceptable amount of high-risk stress VAR? And what is an acceptable market value? Can we start to think about those levels? And then as we change them, what is that going to drive from a compliance and investigation perspective? And where really as an organization do we start to feel comfortable? Is 4% of high-risk VAR an acceptable amount in the energy industry? The answer might be absolutely, or it might be, the market that we make in that space is an extremely efficient market. For us to be holding 4% and to have that much exposure at any one time doesn't seem appropriate. So again, this allows us to start having conversations within the organization around what is our posture going to be related to Volcker. I'm going to jump now over into sources of revenue as kind of another example, and again, starting to think about really the relative nature of compliance. Is again, at this particular case, we're looking at kind of a snapshot of P&L and the different attributes of P&L that make up comprehensive P&L. And I'm sure I'll get a question on spread P&L kind of at the end, but what I would say is I think there is there's still very much an open question on the applicability of spread P&L across different product areas. What I would say is I don't think the metric and the ask by the regulators to provide spread P&L is going to go away. And I think it's good for organizations to start to think around, especially for more illiquid securities or moving into the fixed income space, et cetera, where there's not truly a market or there's not truly a liquid market, is how do you potentially think about a proxy for spread P&L? But again, this is kind of more of an equities based where we could put, we can calculate spread P&L, fees and commissions, as well as realized and unrealized P&L. And then we're able to start to look at what is kind of the, if we look down on 2A, and if Patrick can kind of highlight a couple of those desks. If we do look down on 2A, what we're able to see is that we're able to look at, what is kind of for, realized P&L attribution, what is the percent new trades, what are trades were amended, what were any drop trades, etc., as well as we're able to start to see the breakout of, number one, relative current period P&L across the group over in 1C, as well as the breakdown kind of by how are they making their money. Are they making their money on the spread, on fees and commissions, on asset appreciation, etc. So again, so now what do we do with this information? If we go to 2A, the goal of 2A here, again, is to start thinking around, so what does permitted market making look like? And how do we actually think about this as a relative threshold? What percentage of sources of revenue do we consider acceptable to be, kind of good P&L versus bad P&L? Recently, when I was talking to an organization about this, the head of strategy told me that all the P's are good and all the L's are bad. But what I mean by good P&L in this particular case is, are we making money in a way that regulators see as proprietary, meaning based on asset appreciation, or are we making money based on market-making activities such as spread P&L or fees and commissions? And the idea here now is that we can start to look at a threshold. Is 50%, if we're making 50% of our money on the bid-ask spread, but plus fees and commissions, is that an appropriate threshold to set for an equities business? I mean, I think it's obviously very firm specific, but the idea here is now at the desk, at the trader, at the account level, at the trade book level, we can start to have some of those discussions and think about, what does a threshold look like? Do we have, is our equity trading activities consistent across our organization? Do we have different desks that are making markets in different ways? Are some of them significantly more liquid than others, etc.? All of that now we can start to think about. So then after that, what do we have to investigate? What's below the line versus above the line? In this particular example, we have information technology, healthcare, and utilities that are sitting below the line. Doesn't necessarily mean it's proprietary trading, but it means for whatever reason right now, they're making more than 51% of their P&L based on asset appreciation. So I think the final area that you want to talk about again in terms of how to how we're thinking about this drill down is really kind of revenue relative to risk. So, one of the areas that we started to think about is, and I think thinking about revenue relative to risk is, how are firms trending and how are traders trending in terms of how they're making their money? So, as an example, breaking up the desks and looking at, what is a percentage of unprofitable trading days, and then if we start to break out comprehensive P&L into subcategories, are we seeing, for example, an equal number or an even distribution of, up on 1A and 1B, we're looking at comprehensive P&L. Down on the bottom, we're looking at we're looking at just asset appreciation. Are we seeing areas where there's deviations, meaning that comprehensive P&L realistically, if we saw 30 days of positive comprehensive P&L for a book that had a low amount of asset appreciation P&L, then we would say that that's okay, because they're making all of their money in a relatively low risk method, and they're essentially just performing market making activities. Versus if we started to see that comprehensive P&L is all positive, as well as really asset appreciation is all positive, that potentially brings up the possibility that that they're making their money essentially through proprietary trading. So again, this allows us to start asking questions around how desks are making their money, and then what are the trends showing. Are we seeing, as if we look, for example, in 2B here, where there's more unprofitable days than profitable days, and from an asset appreciation perspective. So I guess that could be prop trading, but probably more realistically, it's random market movements. And then when we look up on top, we see that profitable at the comprehensive level is much more consistent. So we're able to say, what, this is not really indicative of kind of a prop strategy, and it allows us to start to drill in, not just again at the P&L level, but to start to actually look at an individual day level. Are we able to tell a story around Volcker compliance?